Hey everyone, in this video we're going to go over Tattooed Chef. I'm going to go through my stock analysis on it. I am going to let you know what I think about the stock, if it is worth buying. Many of you have asked me to look into Tattooed Chef. You've written it in the comments, you've DM'd me on Twitter, multiple people asking about it, so today's the day we do it. But before we get started, please smash the like button. It really helps the YouTube algorithm. And if you haven't subscribed yet, please subscribe. We just passed 700 subscribers and I'm trying to get to the 1,000 mark. We've been growing pretty steadily and I appreciate all of you for helping with that. If you could share the video to anybody who is looking to learn more about Tattooed Chef, that would be much appreciated. Let's get into this. So I've got so many requests to look into Tattooed Chef. This is the video that is going to give you my honest opinion about the stock and its prospects. I'm not going to just tell you, what you want to hear, buy, buy, buy. I'm going to tell you the real numbers, and I'm going to tell you, based on those numbers, if I think it's a buy or not. Now, many of you probably know Tattooed Chef the same way I probably heard about it, which is from this YouTube guy, Jeremy from Financial Education. He has an amazing channel, and my analytics show me many of you watch his channel as well, so assuming you've watched his channel, then you probably know he talks about Tattooed Chef a lot, and it's clear he talks about it because he owns a large position in it. So just to give you this, basically, when you own a stock, it's easy to talk about the bullish points and leave out some of the not so bullish points. Now, I'm not saying that's what Jeremy's doing, but it's clear he has over $1 million across his accounts in Tattooed Chef. He's a very smart investor. I believe him on all the bullish points he mentions in his videos. And this is not a dig at him in any way because I'm a huge fan of his channel, but I'm just going to go at this from someone who doesn't own any Tattooed Chef stock, because I don't own any stock as of right now, and I'm going to go over the numbers and tell you the things that worry me and the things that I like about the stock, and be very, very transparent about both. And that's what I like to do, is I like to try to be as transparent as possible when talking about any stock, whether I own it or not. The first thing we're going to do is go over the revenue and the operating income. Basically, this chart is just showing you quarter over quarter since their IPO and whatnot, how revenue has went. And revenue is clearly going up, from Q3 2019, 24.7 million, all the way to 52.68 million in Q1, so last quarter. We have their Q2 coming up soon. Now, even though revenue is going up, which is obviously a great sign, the thing that worries me is the red bar, which is operating income. Operating income is basically down more than it's ever been. But we'll get into that in more detail in a future slide. The next thing I want to show you is basically the margins. So this is gross margins. Now, gross margins has basically been between like 10% to 25, 27%. They went up, they came down, now they're back to where they are, just above 25%. These are good margins, but I mean, it's not like gross margins are, we should expect anything dramatic to change and go higher. I think the 20 to 25% range is kind of where it's going to be. Now, the thing I don't like is look at this chart. If we look at operating margins, we see, in 2019, it was coming up to as much as a little over 20% and then a steady decline downward all the way to the point where it was like negative 13.3% in Q1 2021. So I do want to see this kind of reverse back up. Now, if we're looking at operating expenses, which is probably where most of this comes from, we can see that the expenses continuously is going higher. And in Q1 2021, the expenses really shot up. And my belief is most of this is sales and marketing. Now, as you can see, they just say total operating expenses we see. I don't believe they're breaking out sales and marketing anymore. And the reason I don't think they're doing that is because I think sales and marketing are just an overwhelmingly high expense right now, and they probably don't want to show how much they're spending on it. Now, I could be wrong, but that's my current belief. So if we look here at this chart of growth year over year, we see this really high growth rate. I mean, it was over 60%. Right now, it's just under 60%. But basically, year over year, the growth is tremendous. I mean, if you just saw this, you'd think, wow, this is an amazing company. But now I'm going to show you what this really high growth rate looks like when you put it right next to the operating expenses growth. Now, the red line is operating expenses year over year, and it is just skyrocketing high. I mean, it's just like just under 800% increased operating expenses. So the question is like a 60% growth rate worth spending 800% more money? And clearly that's not sustainable. So from the most recent earnings report, we see 2021 first quarter had 52.6 million versus 33.1 million in revenue in 2020. The cost of goods sold, 39 million versus 23.9 million, and that basically gives you a gross profit of 13.6 million versus 9.3 million in 2020. Now that all looks great till you see that operating expenses. Operating expenses of 20.693 million this year in first quarter versus 2.39 million. What a massive increase. So is the increase in gross profit worth the increase in operating expenses? The clear answer is no, because if you look at the bottom line, the income shows negative 7 million in this first quarter versus a positive of close to 7 million last year. So the question is, this is obviously not sustainable. Will things change going forward? And that is yet to be seen. Now, I obviously think that that operating expense is based on marketing, and maybe they spend a lot on marketing now, and then those people they acquire to buy their product continue to buy for many years to come. But are they going to stop spending on marketing? You know, it's a very tricky situation because we don't know the cost of acquisition for them. Then I went to just check how many shares exist and how are they changing. And in a very short period of time between August of 2020 until the end of the first quarter, March 31st, 2021, they went from 20.65 million shares to 81.4 million. This is a ton of dilution. Now, I want to be clear, I didn't look deep into this, so it could have been for good reason. Maybe they issued shares to raise money for opening new facilities and they needed the money. Maybe it had to do with their transfer from the SPAC. Maybe it had to do with some type of employee compensation that was from the past that they owed. I don't know what it was, but I just want everyone to have an eye on it, understand it exists, and understand that going forward, it would definitely be a red flag if they continued to dilute shareholders by a large amount the way the trend looked over there. The next thing we're going to go over is price to sales. So Tattooed Chef currently trades with a price to sales of 7.5. The industry median for consumer packaged goods is 1.19 and the S&P 500 average PS is 3.1. Now it is fair for Tattooed Chef to trade at a much higher price to sales because they have very high growth, so that price to sales should come down as they continue to grow their revenue. But it is, important to just point out, as of today, their price to sales is much higher than the average company in their sector or in the S&P 500. Now, in the last earnings report, Q1, they go over their outlook, and I just want to kind of go over some of it. So first, they don't give guidance for Q2, which is about to come soon, but they do give full year 2021 guidance. Now, they expect, continued revenue growth, 58 to 63% compared to 2020, 49% year-over-year growth on the base business. Gross margins are basically going to remain stable, 20 to 25%, so it's going to be slightly less than we saw in Q1. Adjusted EBITDA in the range of 2 million to 4 million, on CapEx in the range of 15 to 20 million. Now, the bottom paragraph worries me a little bit. They say the company is a high growth phase, does not provide guidance for the most directly comparable GAAP measure, net income, and similarly cannot provide a reconciliation between its forecasted adjusted EBITDA and net income metrics without unreasonable effort due to upcoming one-time transactional costs, starting of a new facility, which makes sense, and stock compensation that are unknowable at this time and affect the reliability of estimates for certain items. These items are difficult to estimate and may vary greatly between periods and could significantly impact future financial results. Now, why don't they know the stock-based compensation, how that's going to be? That just confused me a little because we saw stocks, the amount of shares, like the dilution, and I was thinking, could it have to do with stock-based compensation? And now they're not even, being pretty clear about that in that last paragraph. They mention it. They could have just not said anything about it, but the fact they mention it does worry me a little bit. Like, is there going to be a lot more dilution to come? It's something I don't know, and I think I need to look into deeper. And if anyone knows the answer, that'd be great to know. Okay, so summing this all up, the growth in sales is undeniable, and my guess is that the growth is going to be from more locations plus more advertising spend. Now, the problem is I believe they've not optimized ad spend yet, and if they have, then why not break it out on the expenses instead of lumping it in so we can't see exactly how much they're spending on ads? Maybe it will take some time before they optimize the acquisition costs of new customers through advertising. I'm not sure, but it's possible that for now they're spending way too much to acquire a customer, and that's why we're seeing their earnings go down while their revenue is going up. Now, to be clear, I have no problem when a company is losing money while it grows market share. The only thing is when I buy stocks that are losing money to grow market share, I usually accept that fact because they are either A, disrupting an industry, in which case if they succeed, the financials are going to be completely flipped upside down and it could bring havoc on the legacy companies, or B, they're the leader in their space with a very strong moat. Now, unfortunately, I don't believe that Tattooed Chef is either disrupting some industry. I don't believe they're the leader in their space. I believe they are great at marketing their product, maybe not on marketing ad spend yet, but as far as packaging, I believe the product tastes good, but I don't think they're disrupting frozen food. I don't think they are the leader in frozen food or vegetarian, vegan, or plant-based products. And there's huge competition in the plant-based space with companies like Impossible, which I am actually invested in privately, and Beyond Meat in the public markets. Now, the thing is, people like the product, which is good. They probably have a good supply chain and logistical operation. But for me, the bottom line question is, do the financials make sense for me to buy this company right now? For me, I have to say that I might buy the stock in the future, but for today, it's a pass. To anyone invested in Tattooed Chef, I'd love to hear anything I've not mentioned. I'm aware they're going to be expanding into more stores like Kroger and that the revenue should continue to rise. But for me to buy the stock, I want to see the next few quarters, the sales compared to the marketing spend. I hope we get some clarity on those metrics in future earning reports. I think the company has a decent chance at being acquired by a larger company due to its small market cap and brand recognition. I also think the company can work out the expenses and eventually become a highly profitable company. But the bottom line, if you asked me would I rather own Tattooed Chef or bonds, I'd rather own Tattooed Chef. I just think there are better risk-reward stocks for me to choose from today when looking at the entire stock market. So I'm not against having a small allocation and watching how this company unfolds, but overall, for me, there are better buys in the market I would rather own. So for me, I'm going to sit this one back. I'm going to watch, and maybe in the future, I might be a Tattooed Chef holder. But for now, thank you for watching. Please like, please subscribe if you haven't already. If you want to follow us on Twitter or Instagram, it's at FFMResearch. Thank you again so much for watching. I really appreciate you all. Until next time.